Welcome to the Deep Dive. Today, we're diving into Axis Bank's recent Q1 results.
Yes, and it was definitely a quarter with, well, a lot going on under the surface.
Absolutely. We've looked through the details, and the aim today is really to give you the clearest take on what happened, what it actually means, and maybe what to look out for. It wasn't straightforward.
Not at all. Some real complexities in there.
So let's start unpacking. Based on the recent Q1 results of Axis Bank, the first impression is, well, a bit challenging. There was this significant technical impact on how they recognize loan slippages.
Right, that definitely colored the numbers.
And the net interest margin, the NIM, that's a decline too.
It did. But it wasn't all negative, was it?
No, exactly.
Right.
There were some bright spots. Cost management seemed pretty tight.
Agreed. And non-interest income looked quite strong.
Yeah, pre-provision profit actually grew by, 14%?
It did, 14%. But what's interesting there is how much of that lift came from trading gains. A pretty steep surge, actually.
Ah, okay. So not purely core operations driving that number.
Precisely. If you strip out those trading gains, the core operating profit growth was much more modest, around 4% year on year. Still, it does show they're keeping a good handle on costs, even when, business growth itself was a bit sluggish. Incremental advances actually outpaced deposits.
That's a key point. And it's interesting, too. Based on the recent Q1 results of Axis Bank, the stock hasn't done too well over the past year.
No, it's underperformed, down about 6%, while the Nifty was up 3%, and Bank Nifty up 11%.
So maybe limited downside from here. Or does it signal deeper market concerns?
Well, that's the question, isn't it? Let's dig into the actual numbers.
Okay, so net interest income, NII. Based on the recent Q1 results of Axis Bank, it was rupees 13,560 crore in Q1 FY26.
Which, for context, 1 crore is 10 million rupees.
Right, and that was up just 1% year on year, but actually down 2% from the previous quarter, Q4.
A bit weak on the core NII front, then.
Yeah, but then other income, that was a different story. Rupees 7,258 crore.
Big jump there. Up 25% year on year and 7% sequentially.
So that helped boost the total income figure.
It did. Total income hit rupees 20,818 crore, up 8% year on year. But, and this is a big but.
The provisions.
Exactly. Provisions, the money set aside for potential bad loans, they just skyrocketed. Rupees 3,948 crore, that's up 94% compared to last year's Q1, and a massive 190% jump from the previous quarter.
Wow. That's a huge increase. So that obviously hit the bottom line.
Absolutely. It meant profit before tax fell 6% year on year, and the final profit after tax, PT, was down 4% year on year to rupees 5,806.1 crore. So naturally, you have to ask, why such a dramatic rise in provisions? What's going on there?
Right, which brings us back to that technical impact we mentioned earlier. Let's unpack that because it seems crucial.
It really is.
So based on the recent Q1 results of Axis Bank, the bank adopted a, let's say, more conservative way of recognizing potential loan issues or slippages.
Basically applying the rules more stringently across the board. Proactive, you could say?
Yes, proactive. And this mainly affected cash credit and overdraft-type products. Around rupees 2,709 crore of the gross slippage number was directly because of this technical change.
And mostly from the retail side, right?
Correct. Rupees 2,165 crore from the retail book.
So it's fascinating how this adjustment really changes the picture. Gross slippage reported was rupees 8,200 crore, but without this technical impact, it would have been rupees 5,491 crore. Quite a difference.
Same for profit, right. Reported payee was rupees 5,806 crore.
But it would have been closer to rupees 6,420 crore without that impact.
Now, management did say that about 80% of these newly flagged slippages have collateral.
Suggesting the actual economic loss might be minimal.
True. But even if you adjust for the technical impact, the underlying credit costs, both gross and net, were still elevated compared to previous quarters.
Yeah, that's a key observation. It wasn't just the technical change pushing costs up. There seems to be some underlying pressure, too.
So the big question is, was this a one-time cleanup, or are there ongoing asset quality concerns we need to watch?
That's exactly it. How much is accounting? How much is the real underlying trend? And that feeds directly into profitability, especially NIM.
Let's talk NIM then. Net interest margin. Based on the recent Q1 results of Axis Bank, it fell 17 basis points sequentially, down to 3.8%.
Right. And while they did manage to bring down their cost of deposits and overall cost of funds a bit, which is good.
By 12 and 11 basis points, yeah.
That technical impact we discussed, it only accounted for about 1 basis point of that NIM decline. Very minor.
So the main driver for the NIM drop was something else.
Yes. It was mostly absorbing the impact of interest rate cuts on their lending book, about 25 basis points worth in Q1. And with 72% of their loans being floating rate, they reprice quickly. So there's still about 75 basis points of rate cut impact expected to hit in Q2.
Oof. So more pressure coming, potentially. Although the bank sounds confident.
They are. They're guiding for NIM around 3.8% through the cycle. But, if you look at the trend, NI peaked at 4.26% back in Q3 FY23. It's been drifting down since then.
Okay, makes sense. Now, what about actual business growth? How did deposits fare? Based on the recent Q1 results of Axis Bank, deposit performance was, pretty weak this quarter. Actual sequential degrowth.
Yeah, not great. Total deposits down 1% from Q4, savings accounts down 2%, current accounts down 2.3%.
So the low-cost CASA base took a hit sequentially.
Although on a quarterly average basis, CASA did show slight positive growth, about 2.3%, so maybe a slight mix improvement there. But overall advances growth at 8.1% year-on-year was actually lower than the system average, and it was led mainly by SME loans.
And sequentially?
Sequentially, advances grew 1.8%, but that growth was led by lower-yielding corporate loans.
So growing the loan book, but with less profitable loans, relatively speaking, that wouldn't help the NIM situation much.
Exactly. It raises more questions about any potential NIM uptick.
And here's something that really caught my eye based on the recent Q1 results of Axis Bank. The retail loan book didn't grow sequentially.
Flat retail growth, and a sharp sequential fall in rural loans, too.
Yeah, that definitely needs watching. Retail and rural are usually key growth engines.
And with loans growing, even if slowly, while deposits shrank sequentially, that pushes up the credit-to-deposit ratio.
Right, the CD ratio inched up. So they're lending out a slightly higher proportion of their deposit base.
Which can be efficient, but also carries liquidity implications if deposit growth doesn't pick up.
Okay, so putting it all together, what's the outlook? Looks like some challenges ahead for improving return on assets, the ROA, in the near term.
Yeah, based on the recent Q1 results of Axis Bank, the outlook for FY26 seems a bit cautious, given the slightly tentative asset quality picture and the margin pressure we discussed.
So ROA improvement might be tough this year.
Looks that way. But the expectation, or the hope perhaps, is for a gradual recovery starting from FY27, leveraging the bank's franchise strength. Projections do show NII, other income, and PEAT rising through FY26 and FY27 estimates. PEAT, for instance, is projected around Rs 26,882 crore in FY2060, and then up to Rs 31,131 crore in FY27.
Okay, so growth is expected to resume. But what about the efficiency ratios like ROA and ROE?
Right. Well, based on the recent Q1 results of Axis Bank, both ROA and ROE are actually projected to dip slightly in FY26 compared to FY25, before a small recovery in FY27. So ROA, for example, projected at 1.60% in FY26 estimate, down from 1.71% in FY25, then maybe recovering slightly in FY27.
Interesting. So a bit of a pause in profitability improvement before potentially picking up again. Given the stock's underperformance, maybe the market has already priced in some of this weakness. Limited downside, perhaps?
That's the argument some analysts are making, that the post-earnings correction might offer a long-term accumulation opportunity for investors who believe in the franchise.
But there are always risks, of course.
Absolutely. A severe macro slowdown is always a risk for banks, impacting growth and asset quality.
And specifically for Axis, maybe an inability to really ramp up that deposit growth.
Yes, that's a key one to watch, especially low-cost CASA growth. If that lags, margin pressure could intensify.
So this deep dive into Axis Bank's Q1 really shows just how much can be going on behind the headline numbers.
It's never just one number, is it? You've got conservative accounting, market pressures, strategic shifts, all playing out.
For you, our listener, the key takeaway is probably the importance of looking deeper, understanding things like that technical impact or how rate cuts filter through.
And it really raises that central question going forward. How does the bank balance this quite aggressive provisioning stance with its need to drive growth, especially in those crucial retail and rural segments? What will that balancing act mean for their profitability path over the next year or two? It's definitely a dynamic situation.
Requires a nuanced view, for sure. We hope this deep dive has given you a clearer picture and maybe a few aha moments. And just a reminder, we are not SEBI-registered financial advisors. If you are considering making any investment decisions, please consult a certified financial advisor.